Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's PreMarket Prep. Spencer Israel here with Joel Elconin and Dennis Dick on the show today. Earnings, a couple of them, E-Trade, Coke, American Express. This morning, we've got a bearish note from Credit Suisse on retail, so we'll talk about that. And two guests on the radar today. First up at 8:35, we'll be joined by Will Rind. He's the founder and CEO of GraniteShares. He's got a new ETF, XOUT is the symbol. It takes the S&P 500 and gets rid of the 250 worst companies in that group. So that'll be at 8:35. And at 8:50, we'll be joined by the author of the article we talked about yesterday, William Cohan, special correspondent for Vanity Fair, to talk about that article he wrote for them on insider trading. That'll be again at 8:50. Before I go to Joel, want to remind you folks, a couple things. Today's show is sponsored by Webull and their WeTrader competition. Join traders from around the world in a paper trading contest that resets every Monday, October 7th through November 9th, with weekly prizes of nearly $11,000 worth of Amazon gift cards and a grand prize of either a Tesla Model 3 or $40,000 towards your student loans. Plus, Webull will donate a portion of total returns to the Shriners Hospital for Children. To learn more, download the Webull app. Also, the Benzinga, or the latest Benzinga Cannabis Capital Conference next week in Chicago. BenzingaCannabisConference.com/Chicago. Promo code BZFAN, BZFAN will get you a discount. As I mentioned yesterday, movers, shakers, CEOs, investors, all coming together. So that's next week in Chicago. BenzingaCannabisConference.com/Chicago, code BZFAN. Now, Joel, tell us what's happening here overnight.
We're in the green just by a little bit here, by 2 points. Pre-market high, 0.125. Not much there, folks. What I'm looking for us is to take out that high from yesterday at 3,008 and greener skies ahead after that. Pre-market low, 89 even. That's just below the close in the intraday low. So tight range. We've actually had a tight range over the last two sessions. So I don't know if we're going to have a sleepy Friday here or get a move in either direction. Double bottom at 29.85 if you're looking for support under the pre-market low. Crude's in the green here by 64 cents at 54.67. Gold in the red by 5.20 at 14.93.10. Silver going the same way today, down 9.2 cents at 17.52. Bitcoin, that's in the red too, under 8,000, down $135. The futures are down at 7,925. Triple D, how you doing this morning?
I'm looking at a retail wreck here this morning, and I mean a wreck. It probably is kickstarted from Guild and Active Wear last night, which is trading down 27%. So you're going to see all your apparel retailers trading down. But then to just throw more of them under the bus here, we got a CS note that is downgrading Macy's, L Brands, and the Gap to a sell. So when I'm looking at my filters here this morning, obviously I have filters that are running 1,000 stocks. They show me what is up, what is down. My down filter is littered with retail stocks. Thoughts, concerns?
Well, it's just the notes out on just a couple, right?
No, Guild and Activewear is what really the catalyst here, Joel.
Okay.
So let's go look at GIL because this is what happened last night. They warned, and it's down 27%. So this all the retailers are going to be down.
$10.
The CS note helped it out. 27% GIL. Down $10. It's a $35 stock. It's now a $25 stock. This is an enormous move for GIL. Spencer Israel, this warning must have been significant. This thing hasn't even thought about catching a bid yet. It slowed down at 30 for about 20 minutes and then just continued to collapse here. I mean, this is a real wreck.
Well, they lowered their Q3 adjusted EPS guidance from 57 cents a share to 53 cents a share, and they also cut their full year adjusted EPS guidance from a range of $1.95 to $2 to a range of $1.65 to $1.70. So they cut that by 30 cents.
This is a stock, a retail stock that actually had performed fairly well. I mean, it had a little bit of a rough last half of the year, but this stock started the year at 30, ran to 40. August topped out, and we've been going down ever since. Well, now we're not only giving back the entire year's gains, we are going to last year's gains and trying to give them back all in one foul swoop. And here we are trading down at $25.50. I don't even know what to say. There is a couple lows here. If we go back to the middle of 2018, we got down to 25.50 and 25.33 in 2 consecutive weeks. I look at that, Joel. Maybe that holds. If you're trying to buy this thing, you are doing the definition of trying to catch a falling knife.
I mean, I see a stock. I mean, it's just my contrarian instinct in here. I would just
buy this.
Well, if I was short, I mean, I'd be bringing in. I know people aren't short for the most part, but holy macro! I mean, what a windfall! If you are, I'm not sure what your short interest in on this stock. But
what if you're long, and you know there's some people long? What if you're long? What do you do? I mean, the thing's down. It closed at $35. This wasn't on the docket. It wasn't. This wasn't supposed to report, was it, Spencer? This was just a flat out warning out of the blue, right?
Yeah. Guidance warnings are never scheduled.
Yeah. So this is just a flat out, like, here you are, you're looking at it. And this is why I'm going to make this argument. Technicals work well in the absence of fundamental news. I mean, this was looking like, oh, it stopped going down. Here's, 34.42. This is if I was analyzing the chart. You could even argue, oh, there's a little cup and handle kind of forming. Maybe we're going to start getting kickstarted in Guild and Activewear. Doesn't matter. None of that's meaningless when the company comes out and has a significant earnings warning. Stock's going down no matter how pretty the chart was. I mean, this was a stock that was still in a downtrend, so it wasn't a pretty chart. But you could have argued that, hey, maybe it stopped going down. Maybe, this is one that I might want to try to play for a bounce technically. It's down $10 on you now. And there's no hope of that thing going back. I mean, when stocks go down 5%, sometimes, on light volume, but this thing's now trading heavy volume. It's been trading since last night. This is just flat out ugly.
If I was long on a day trade, I think I would just do the old Dennis, just swallow the pill and, and get out of it.
Yep.
If I was oh man, but you see 2 monthly lows here. Let me see. This is going back to the middle of 2018 at the 25.5 area. So 25, even at 25.5. I'm absolutely not shorting it in that area. I guess the safest way to play it, if you absolutely have to try along in this stock today, let it shake out. Let's say opens 25.60, and there's probably be some stops in there. I don't know if there's still stops nowadays. And let's say they flush it. I'm just giving a hypothetical scenario here. They flush it down to 24.50. And then all the shorts are like, oh boy, I'm going to go $20. I'm going to get this at 20, 21, 22. And then it turns around and comes back up through the open. And then you have that first 15-minute low, let's say, to lean on. I mean, I think that would be, unless you're just bold. Like if I was short a good amount, I'd be out there. I'd be participating in the opening print no matter what. To cover short, but that's
a no-brainer. If you're short the thing, you're getting $10 overnight. I would probably cover too. It's a scalper blood in this, Joel. We played market making roles for a lot of years. I mean, you get 28% overnight just out of the blue. It felt, obviously you're going to be covering in. It's just a matter of, I don't, like I said, I feel there's going to be a lot of people stuck long this thing potentially. And you look and you're like, I down 28%. If you got in your long-term portfolio, I don't know. But if you've got in your short-term trading account, I have been in positions where I've held a stock overnight and it's fallen 40%, or it's, I've been short a stock and it's got taken over. I've had that happen to me twice, where I've been short a stock in an overnight portfolio that's been taken over, and I eat it. I eat it immediately. I know it's horrible to eat a 10-point loss in something. It sometimes kills your day, your week, maybe even your month if it was big enough. But this is one more reason to stay diversified in your trading portfolio as well, because stuff like this happens. There's so many traders that trade overnight and then they go on margin and they're putting all their eggs in one basket. I mean, if you've got all your equity tied up in one stock like a Gildanware and it falls 30%, how do you stomach that? How do you take a hit like that? But if you're staying, and I use a rule of thumb, I never like to have more than 10% of my trading capital in any one stock. So if you got a $100,000 account, I don't like to have more than $10,000 in any given stock, just in case something like this happens, because it does. I've been in the business 20 years. I've twice had a stock taken over that I was short. I've also had stocks taken over that I've been long, and those are awesome. But twice I've been, caught short a stock that's been taken over. What do? I immediately cover the next day. This is the opposite. It's really bad news, but it's kind of equivalent because the stock is taking a rough. It goes up 20, 30%. I mean, you've got a stock, if you're long, it's down 30%. A lot of people will hold and say, well, it's down too far now. I can't sell it down here because I'm down too much money. This is how you have, a loser become even a bigger loser of your portfolio, and the mental capital, the drain that it takes on you when you wake up every morning, you're looking at this again and again, and if it continues to leak, it's more of a mental drain on not only your trading capital but your mental trading capital, and that's why I just eat the loss. If it's an overnight trade and you were in it, or you're a swing trade and you had to stop, let's say I'm going to stop out at 33, it's at 25, it sucks, but I eat the loss.
Hey, Dennis, did you get the chance to hop in the YouTube chat today?
Yeah, I'm in there.
Okay.
I've been watching it. I'm PreMarket Info in the YouTube chat. That was our old handle from years ago, PreMarket Info. So here, I'll say hi to the YouTube chat.
Okay, because I'm like, okay, I didn't type that this morning, and I'm like, I didn't know. Okay, thanks for.
I'm logged in. I got to find a different Google. I should change the name there, but yeah. So we used to be called PreMarket Info. We changed to PreMarket Prep a lot of years ago there, but I've still got that old handle, PreMarket Info. So, anyways, that's.
I like the bird. Remember the bird? It took us
It's good.
It took us months to decide on that bird. Twitter.
We were worried Twitter was going to sue us.
Yeah.
We got a blue bird too. Ours has a worm in the mouth though.
Yeah, I think we were. Well, I think we're a little bit ahead of that. Early bird gets the worm. That's
why we took that. Early bird gets the worm. Oh, look, Guild and Active is rallying here. So anyway, there is support at 25. So there is a support level here. But if you're holding out, hope that's coming back to 30 anytime soon.
Nope.
I don't think so. The repercussions from this are not just with Guild and Active, where I'm seeing every apparel maker in my filter here this morning. Down filter, trading down. We got VF Corp down $1. Offered down $1. No trades yet, but it's offered down $1. Nobody lifting that offer, telling me it wants to go lower. Ralph Lauren is offered down $1.50. Nobody lifting that offer. It's telling me it wants to go lower. So just because these things are down $1.50, it's going to be uglier on these stocks, believe it or not. VF Corp, Ralph Lauren are going to open significantly lower than the $1.50, I would think. PVH, same story. It's down $1.18. Offered down $1.50. Best bid is almost 5 points below that, 3 points below that. So I think these stocks are going to lose $3-4. Sorry if you're long any of these things, but it's going to be an ugly day for all these retailers. Even Kohl's trading down here, $1.20. Obviously, there's the other note from Credit Suisse that is hurting the sector here. Spencer, give us the details from that CS note.
Well, yeah, you kind of mentioned already. But,
I took your thunder, but say it again.
That's okay. Gap, Macy's, and L Brands all downgraded from neutral to underperform. I'll give you the price targets. Price target on Gap is $14. Ooh. On Macy's is $12, and L Brands is $14.
This is one of the most bearish notes we've seen from this sector in a long time. All downgrade to equivalent to sell. CS calls it the underperform. The price target's much lower. All these stocks have significant dividend yields. L Brands 7%. What was the other one? L Brands Gap. The Gap has a dividend yield of 5.8%. And then you have Macy's now sporting a 10% dividend. 10.
How can you go wrong?
Tell you how you can go wrong is if this stock continues to go down and the stock continues to underperform, they slash that dividend. We've looked at this before, and there was somebody on our show talking about the coverage. They do have coverage. I think the dividend is safe for now. But I'll tell you, the stock, even if you're going wrong, think about this. When you buy a stock at $15 and it's got 10% dividend, if it goes down to $1.50 in the next year, you're losing money overall. Well, I mean, let's look at what Macy's has done here in the last couple of years. It's went from $40 down to $15. So if you've been holding for the last 2 years, you've got $3 in dividends. Hooray, hooray, while you're down 25 points. So that's how you can go wrong. Even when they don't cut the dividend, it can be a bad trade. I mean, is Macy's going out of business? We don't know. I've said before, and this is why I don't own any retailers in my long-term portfolios, because I don't know which ones are Sears. I don't know if Macy's is Sears. I don't know if Nordstrom, and maybe Nordstrom a little bit better. Like I said, I like Kohl's the best of all of these, but I don't like any of them. So I have 100 stocks in my long-term portfolio, almost 0 retail stocks. And if I was to have one, I might have Lululemon just because it's been such a great performer, but evaluation scares me on that. I just do not like the sector. Again, there's so many issues. Amazon been eating lunch. People buying stuff. People aren't going to these big stores. The expenses in the department stores. People aren't going to the malls. That Macy's anchors every mall. I mean, there's so many tough. There's so many, bearish. There's so much bearish sentiment And there's so many things to think about when you're buying these things. I can't buy them.
Well, two things. One, we haven't had that retail hell in a while. Like there's sometimes when, things just get pounded. But for me, just like yesterday, when we said that, it was a big day for Netflix, it had the report, it had big gains, it gave it away. I think today's a big day because, Credit Suisse is coming in now and telling me to sell my Macy's and telling me to sell my L brands, which I do own at a much higher price. I mean, come on. Is it either like super late to the party, or do these things really have like another leg down?
That's the question.
Yeah.
I almost think it's the latter, Joel. Like I'm almost thinking these things do have another lag down. I mean, why not? L Brands has went from 50 to 18. It's down another buck here this morning at 17. Why can't it go to their price target? I think you said 14. Why can't it go to 10? Are these stocks turning it around? Are these companies turning around? All of these are mall based. I mean, the Gap, yes, they got the Old Navy, and that's interesting. And what's happening with that? Have we heard like when this potential spinoff? I know they talked about. Are they ever spinning off Old Navy? Did that happen? I don't think it happened.
No, I actually
What's the timeline for that?
I haven't followed up on that.
I mean, yes, you're going to get Old Navy. That's exciting as a Gap holder. I mean, that's maybe one catalyst for the stock eventually. But still, you look at those Gap stores, nobody's going in those. Not like they used to. And one thing to consider, and this is a big consideration, is people think, oh, these aren't going out of business. So what if the sales fall 10%? What if the sales fall 20%? They're still making money. No, they're not, actually. When they sales start falling 10, 20%, check out their margins. The margins are tight. They have huge overhead expenses. They have huge rent to pay. I mean, think about the size of a Macy's. Think about what it costs to operate that store. They're tight, the margins. When the margins fall, when the sales start to fall 5 to 10%, these companies can potentially go out of business. I mean, this is what happened with Sears. This is what's happening with JCPenney. It's very difficult to say that Macy's is not a Sears or a JCPenney, and that's why I stay out. I don't know. Maybe they do turn it around, but I don't see much difference when I look at a Macy's and I look at a JCPenney. I just don't see that much difference, and that's why I'm too scared to own Macy's.
From a risk-reward standpoint, I hate to trade. I hate to trade from coming out of Credit Suisse.
You like them long here. Well, you're long L.
No. Well, I'm long L brand, so I'm a little bit. But from a risk-reward standpoint, so it's saying 14 target. You short here at 17. You got to stop at 18.50, so that $1.50 and trying to get 14.
And let's be honest, they put the call at an 18.10. So really, yeah, if you're following them, but they're short from 18.10. Well, their calls from 18.10. So their kick start at 6%. They move at 6% in their favor just from their call. But
all right. Well,
I don't mind it. They're coming out, and yes, they're late to the party, but maybe they're just admitting that we've been wrong. I mean, they were neutral. Where were they on all three of these stocks? Let's go look. So before, they were neutral on L Brands, neutral on Macy's, and neutral on Gap. So they weren't bullish. And now they're flat out coming out and saying, look, the story's getting worse, and we're going to sell. I don't mind that.
Okay. All right.
I don't mind that. I would not want to be long these stocks. I'm not long. I'm sorry, Joel, that you're long L Brands. I know I bought it with you. And I thought L Brands could have a bounce, but eventually I just gave up on it because it wasn't having a bounce. And I think I ended up selling around $30. I'm glad I did. But, sometimes I get stuck holding the bag, too. I have a lot of horrible stocks in my long-term portfolio, too. Yeah, and I thought those stories were turning around, and they didn't. So this happens to everyone. If you got a long-term portfolio and you're holding stocks long-term, you're going to have some dogs. As long as you stay diversified, hopefully the winners are going to, overcompensate for the losers. But I don't see any reason why these stocks are imminently turning it around. And that's why I stay bearish all the retail stocks. I mean, people would look at my portfolio and they probably say, why don't you have any retail stocks? You don't have any exposure to retail. And I'm like, well, here, I could go buy a Walmart or a Target or a Home Depot, and I'm paying up for the things. I mean, these stocks at the beginning of 2019 on Home Depot was $160. It's $237. Beginning of 2019, Walmart was $85. It's $120. Target at the beginning was $60, $113. It's doubled this year. If you're buying it now, you're late to the party. So I had a couple of stocks.
For full disclosure, this was Lisa's pick. This was not my pick.
L Brands. I'm blaming your wife. Lisa, I'll throw the end of the bus on the show.
She's had some good ones and some bad ones. Let's do
who's wearing lingerie anymore?
I don't know.
The one thing I'll add, just not for Macy's, but for L Brands and the Gap, surprising majority of analysts are neutral, right? So you think about the bearish trends, but most analysts, the majority of them are neutral for both. So this is just one of those neutrals going to the sell side.
It's hard. It's hard to say come in and buy these stocks. What's going to turn? What is the catalyst to turn around Macy's? What is the catalyst? Because I see it all the time on
real
CNBC.
estate.
I have been listening to all these people on CNBC come on and say, "Oh, it's got a 6% dividend. It's got it." Then they come on, 2 or 3 months later. It's got a 7% dividend. Then it's got an 8%. It's got a 10% dividend here now. Why is it turning around? Why is it not Sears? Why is it not JCPenney? Macy's, you guys could tell us too. I don't know why, how it's different. I look at Macy's, I look at JCPenney, I see very similar business models, I see very similar stores. That's why I just cannot jump on this band. Like people saying 10%, how can you go wrong? You can go very wrong.
All right, let's do some earnings.
Go back to the earnings parade here because I'm all wound up here this morning again.
I know, I don't want to talk about retail stocks anymore. I will
well, we haven't talked retail in a long time, so there's a lot of we covered like 10 stocks there, so we did good. We tried to talk.
Which report would you like to start with? We've got E-Trade, we've got Coke, we've got American Express. Any preferences? I'll go with E-Trade. All right, E-Trade after the close yesterday beat on their EPS, beat on their sales. It was a good report. I'm surprised it actually matters this much, though.
That's it. Why? Why is the stock trading up 4.5%? We don't care about this quarter. We know you had commissions on this quarter reported. You're not going to have the benefit of having commissions the next quarter. So are they going to lower guidance? Like there's no way they can make as much money as they were previously making.
They did that already. They already
zero commissions. Can they?
They already lowered their guidance like 2 weeks ago.
Yeah. So now we're looking at that and saying, oh, it's pretty good. We're going to go buy this thing at $41, $42, the same price almost it was at before they went to zero commissions. I think it's nuts. So no, I'm not a fan. I don't have a position on it because I don't know why. Is it buying all back up? I said I would like it to go to 42. I don't know if it's going to get there today, but that's where I kind of wanted to go to put on a short. I don't know if it's getting there or not, but it's a nice move for E-Trade. I just cannot bring myself to come in here and buy retail stocks when they just went all zero commissions. I look at Ameritrade. I see Ameritrade still trading significantly down, almost 10 points from where it was when they went to zero commissions. And E-Trade's going to get it all back? Nah, sold to you.
All right, yeah, it is trading up here in the pre-market nicely. I always put in EFTC. I don't know why. It's E-Trade, but I always type this one in wrong.
Your dyslexia.
Yes, pre-market high. Where do we go to? We went to 41.25. So we'll use that as a potential target. That's 40 cents away. Can we fill the gap in this issue? And that's up to 42.89. So if you're uber bullish, super bullish here, and you're waiting for a gap fill, there it is. That would be at 42.89. It'll be erasing all those losses. Coming back on the downside. Top of yesterday's range is 40. So, I mean, if it does anything like a Netflix here and goes into reverse, that $40 area should act as support. I noticed Schwab, you can do fractional shares through Schwab now.
This is horrible. Are you like, why? So you're talking like 0.2 of a share?
It's all about customer acquisition. That's the name.
What the hell? People, if you can't afford to buy a one share of Macy's at $15, you shouldn't be trading in the stock market.
What about Amazon?
One share? It's a minimum wage in Canada is $15 for an hour of work. You're going to tell me you're going to allow 0.5 shares so somebody can buy half a share? Like they can put $7 into Macy's? Is that for real?
Or they can buy a half share of Amazon for like $700.
Okay, well, fine. So you can buy. So maybe there's a better argument there. You can buy a half a share of Amazon. So maybe that's the argument, but I don't know.
I mean, how else are young people supposed to get in the market?
I guess Amazon's a good example. And
Priceline,
like half a share, so they can buy $900. I'm annoyed.
AutoZone. I'll keep
one share because I only buy 100 shares. I never come in here and buy. I would never go and buy like maybe on Amazon. Maybe I get that. So Amazon's a good example. So maybe you save over $1,000 or now you do fractional shares, but I don't know. I just think So I find one share annoying. I see this all the time. One share trades, one share. Now I'm getting lifted on a half of a share. Well, obviously, I hope I would not. That's only at Schwab, so it's not the exchanges doing it. But I don't know. I find that annoying.
All right. Next earnings report. What else did we have after?
I know it didn't feel so strongly about that. Let's go to.
This is like really opinionated this morning.
Wow.
I'm always opinionated.
Hey,
don't like retail stocks. Don't like fractional shares. Next.
Well, I just want to say, Aviator One wants to know whether you're in a youth hostel or a sanitarium. I'd go with the sanitarium. He's up north in his cottage.
They committed me.
His wife's grandmother died, so he's up in his cottage.
I know. I'm working out of a bedroom here, so bear with me.
Someone's gonna come in and give him some pills and a little.
I have to have a bed behind me because after this show, I'm exhausted from yelling at you. I gotta go have a nap after this.
Do they put the jacket back on after the show's over? It would hurt.
All right, stop picking on.
It would hurt your shoulder. If
they have to pick on me now because we're not going to have the hot potato game, and they always pick on me through the hot potato game. So because we got a special guest coming on, so there's no hot potato today, and that's why they're picking on me early.
All right, AXP here. They beat on their EPS, they beat on their sales, and the guidance was in line. So.
I knew I shouldn't have put the camera on. They're all making fun of
No, I told you to do it.
Just Zach 157 doesn't want you to put it. He doesn't want to put a cadaver on that gurney back there.
It's gonna be for my shoulder. That's why I have my chiropractic care right there.
All right, come on, Spencer, rein us in.
Yeah, okay. American
American
Express had a good report there.
American Express had a good report. You just got to pay your bills on time with them, or they really ding you.
Only Joel would know that.
No, they do. I pay it. Like I get that American Express bill. I'm like, man,
don't you have it on auto pay?
I don't have everything on auto pay because
put your credit card on auto pay that way because you do get dinged.
Yeah, but then when but I had some problems where I have all these things on auto pay, and then the card gets canceled, and then you lose the list of all the places you have on auto pay. I don't know. It's kind of a pain in the butt.
Auto pay is awesome.
All right. Pre-market high 121.94. We backed off, not too much. The stock just under 122. You've had a seller, so I'll use that. 121, 122. That'd be good. Minor resistance. I don't know if this thing just feels like running today. Just keep in mind, a few weeks ago it was at 111.06, so it's having a nice run. But I just look at all these highs and the 121, 122 area, and I just wondered if those sellers are still there.
What about Coke?
Coca-Cola.
Yeah,
that's your
last report or big report of the morning, really. Coke EPS was in line, 56 cents. Sales beat 9.5 versus $9.48 billion. Why
is it up so much?
They guided some organic sales growth of at least 5%. What else did they say? Full year 20 sales growth up 1 to 2%. I don't know why it's up so much. I mean, they're
pretty good move, up 2.5%. I would think there's some size. JV spec. I don't have my book open. I was too lazy. I didn't open my open book software yet. Is there anything at 55? I would think there's some size at 55. We haven't been there for a while, and that can be a level there. It has traded 507,000 shares, so if it's only 100,000 at 55, it's not enough. But maybe the size is bigger. So we'll see if JV Spec's kicking around the chat, and you can tell us how much size at 55 in the New York buck. I also would want to know if there's size at 56 because that would be the next level after that, or even 55.5. Maybe I should just open my book.
Yep. We got a little confluence here. Your pre-market high comes in at 55.35. September 12th high was 55.31. So we'll use that. After that, you're open up, getting near all-time high, 55.08. 56.08 after that. It could happen. I'm going to go maybe with a little bit of the Jerry Newsom analysis here. The stock was up. Been up the last 2 days, not huge though, because I was thinking if it was up, some people may be selling into it. Big move for Coke here, up $1.36, and I don't know if anybody plays the options in this one, but keep an eye. If it takes out that pre-market high 55.31,
No.
I don't think it's going to race right to 56, but that's really your next major resistance
These stocks
point.
are in favor, though. These consumer staples that are trading with P's at 25, they like them all. Their stocks are in favor. They've so I wouldn't be surprised if it actually does try to race to 56. 100,000 shares offered at 55. 100,000 shares offered at 130,000 shares offered at 56. So that would be my bogey. I mean, if it keeps hanging out here, maybe it doesn't trade above 55 at the open. And obviously these things can turn around, but you get near 56, I think you're going to find sellers up there. So buck higher than this, I'm more interested. I'm not so much interested in shorting at 55.15. Gets up in the upper 55s, I might try from the short side.
All right, that's JV's back 130K at 56. All-time high in this 55.92. All-time closing high right there 55.77. So pretty much an agreement here. If you get up in the upper 55s, 56, nice target if you're on the stock. Not sure what Mr. Buffett's doing.
Let's move on to the movers from yesterday. Netflix almost closed that entire gap. It's down another $1.50 here this morning. I was on the show yesterday saying this thing absolutely needs to hold 300 if you're long. It did not. I believe it is going to give it all back here today. I remain bearish Netflix. I still have my $200 price target on. I have 10 months to get there. I had no position, though. It's just paper trading for you guys.
And you know what was really interesting about this one? I did look at the 300 options off the open, and they still, when the thing was like 308, 309, they wanted like 250 or something like that for the ones that expired today. Little did I know it dropped $16. But if you're like a gap trader on this one, it almost filled the gap from Wednesday's action.
That's unreal because it was up at 3 on the earnings. It was up at what, 317?
We got to almost 320.
320, so it was up almost 30 points and almost gave it all back. What's that tell you? Overhead supply in this like crazy, and people don't believe the stories. And what we told you on the show was 309. Subscriber metrics, we're not that great. This stock likes to trade off, and Jim Cramer said last night too, likes to trade off with subscribers more than earnings. Yes, the earnings were okay. Yes, it's trading with a PE of 55, which isn't crazy, but if the growth is slowing, the PE of 55 is still too high for value guys like me to be interested.
All right, and Spinner's just pointing out your fake meat call of under 100 is getting closer. And
where is it? Beyond Meat, fake meat. I like that, Joel.
115.30
now, and it's $115 down, another $2. The stock is just in free fall here now. Ian Weiner was on our show 2 months ago when stock was $180 and said eventually these stocks that have these incredibly high short interest, eventually these guys are right. It's just a matter of whether they can hold or allowed to hold. They don't get bought in before. So they do appear to going to be right. We talked about this, that it was just irrational and silly. I thought it was down at 200. It went to 230. I still remain bearish. I've been bearish for the last 2.5 months. 3 months really, because like I said, I was bearish before it started to run from the 200 to 230. I made the call. It was going under $100. I believe I made that call. It was $180. So I think it's still going under $100. I gave myself till a full year, but then a week and a half ago, I upped the target. I said $100 by the end of the year. So I shortened my timeline for getting under $100. So I still have 2.5 months here. I think it's going under $100. Gonna have a little squeeze in there. It's went a long ways now. We've been straight down since the McDonald's deal from 160 to 117.
Oh, that was
115.
And
Can have a little pop here or there. Maybe gets another deal or something, and maybe that's a temporary pop. All pops to be sold, in my opinion, in BYND. I believe eventually it's under 100 and much lower than $100.
Where was that offering price at? Remember when
160.
Yeah,
they didn't trade down to it the first day, and I was like, it was 187. They couldn't even find the buyers. Not even remotely close. They had to go all the way down to 160 to find the buyers to obviously swallow all that stock. Those buyers are now regretting it. It took a long time. It was up there for quite a while. So I guess maybe those buyers turned around and sold it in the open market and made money. If they did not, if they decide to hold, they're being punished for that now. This is why you don't buy stocks with ridiculous, well, you can't even estimate because it doesn't make money, but you don't pay $7 or $8 or $10 billion for a company that makes veggie burgers.
Okay. All right. 8:35, Spencer.
Yeah, I guess I need to call around still because apparently Dennis said there's no PLTs in Windsor, so I need to call around.
Yeah, we want to try it. I mean, the stock's gonna be under $100 before we get a chance to even try this thing.
I'm going to call it around in Canada
McDonald's Beyond Meat Burger. I've tried the A&W Beyond Meat Burger, and I told you it didn't pass the 4-year-old test because the 4-year-old would not eat it.
All right, it is 8:35. I do want to bring on our first guest of the day, Will Rind. He is the founder and CEO of GraniteShares. They have a new ETF, ticker XOUT. Will, good morning.
Morning.
So I want to ask you about this XOUT. It is the U.S. large cap. It's a U.S. large cap ETF, but it's got a unique twist on it. Explain what that twist is.
Yeah, so I think, unlike every other strategy really in the investment world, forever that's focused on picking winners, the whole idea here is we're actually trying to identify losers. And the lens that we're using is the forward-facing lens of technological disruption. So we feel that that's probably the largest forward-facing risk that all investors face, and that affects all companies in all sectors. So when you think about large caps and how difficult it is to outperform the market, simply we're asking the question, does it make sense to own every stock in the index? And if you actually exclude the ones most likely to be disrupted through technology, then we feel that's a better way to ultimately outperform the market.
Okay, so what characteristics do these companies that are prone to disruption, what characteristics do they have to be excluded from this ETF?
So we look at 7 fundamental metrics. So they're all, in a way, common sense sort of fundamental metrics, such as, is a company growing its revenues? Is a company investing in R&D? Are they hiring or firing workers? Are they investing back into the business? And so we combine these 7 different metrics into a score 1 to 5. So 5 being best, 1 being worst. And then literally take the 500 largest names in the US market and exclude the 250 that the model feels will most likely underperform the market.
Wait, why is this strategy necessary?
Well, I think that if you think about the evolution of asset management, as we know, traditional active management, i.e. picking winners, has really been largely been a fool's errand. In other words, we've seen numerous academic papers over the years saying that it's almost impossible to outperform the market. I think that traditional indexing, i.e. just holding every stock in the index regardless of whether it's good or bad, that's worked really well over the last 10 years, where we've had this unique monetary policy environment that's kind of allowed companies that maybe in a normal environment would not survive and would not be in the same shape and same status they are today. Over the next 10 years, I think that will be different. I think people will need to think about a different way to invest. I'll give you a quick example. If you just excluded GE from the S&P 500 over the last 2 years, you would have outperformed by 1.22%. So that's just excluding one company. And I think that people, when they're thinking about how to outperform the market, are kind of looking in the wrong place. And that's what we're trying to address with XOUT.
So I assume you've back tested this. What's the performance differential when you actually take this index over time with the S&P 500?
Yeah, so the performance is pretty good. I mean, the actual story is this was being run in a private fund. So yes, we have a back test, et cetera. But really, I think the kind of more important thing is this was actually being run with real money. And the reason why we have an ETF today is because that was successful in a private fund, and the view was taken to commercialize that into an ETF, because obviously there are limits on a private fund and not everybody can buy it. So it's not as scalable as an ETF and not as accessible to investors. And so that's why I've launched the ETF.
And so it's 250 stocks, equal weight. Everything else is the same as SPY, other than this one big difference, right?
That's right. It's not equal weight. It's market cap weighted on the 250. But the big difference here is we're excluding stocks we think are likely to be disrupted over time. And that's kind of a completely unique way of looking at investments.
How do you pick those stocks that you think are going to be disrupted? I mean, that's where obviously your bread and butter is. How do you pick, how do you pick those stocks?
Yeah, so like I said, I mean, we track an index. So it's completely rules-based, but the index was designed with 7 fundamental metrics in mind. And those fundamental metrics are things like revenue growth, like whether companies hiring and firing, tenure of management, investing in R&D. There are a number of different fundamental metrics that we measure. And then we blend those all together into making one score. And that score, with a 1 to 5, recognizes whether a company is going to be in the index or out. It's a quarterly rebalance. So if a company doesn't make it and is going to be X'd out, then they move out from that quarterly rebalance. But I think what's also interesting is a company can also come back into the index, if they redeem themselves and if their score improves over time.
That answers my next question. I was going to ask you, how often do you rebalance? How often do companies go in and out? Nick, give us some examples of some stocks that have been excluded.
Yeah, so I mentioned GE. So GE is one which has never actually been in the index. IBM is another one. And then in terms of right now in the portfolio, in the top 10, you've got companies like Berkshire Hathaway, companies like Walmart, companies like Disney. So some pretty large companies that people will be familiar with. Wells Fargo is also in there. That's probably a bit more obvious to people, but I think some other ones people might be a little bit surprised.
What about, and I've done this for like a long time. I mean, why go to 250? I mean, I look at what I've been doing is I follow the top 10 components in the S&P, and those make up 23% of the index. So who cares? Well, actually, I have to do the top 11 because of Google, doing the split. So right there. So why go 250? Why don't you go the top 11, and who cares about the other 489?
Well, first and foremost, the rather boring answer is we need a properly diversified portfolio to fit the 40 Act rules or the ETF rules. So we need to have a certain number of companies in the stock, in the fund. And I think we've tested a number of different scenarios. And again, I come back to this was run in a private fund for a while, and we felt like 250 was sort of the optimal range, where you could still get good participation in the market. You still get a correlation of 1 to the S&P, the beta of 1, but you're actually excluding, pretty much half of the market in the model.
And like when you're creating these ETFs here, obviously you want to get volume in there. Do you talk to different institutions and say, hey, was this a kind of product that you would trade? Because ultimately, there's a lot of them out there. You want to get them off the ground. Do you see what the institutions want to do when you put something like this together?
Yeah, I mean, I would say that our target market, or the target market really for any ETF company, is going to be the financial advisor. So that's registered investment advisors, that's intermediate broker-dealer financial advisors, but it's mainly intermediaries and mainly financial advisors. So we certainly road test some of these ideas, but a lot of what we do and what other companies do, in the ETF space is we're coming up with ideas that this for the first time, no one's ever seen before. And so with XL, sometimes what happens is, the old Henry Ford kind of saying where if you ask the customers what they want, they would say a new horse. And so sometimes, people, it's hard to see and appreciate something completely new when you're seeing it for the first time. So sometimes, although feedback's important, sometimes you have to go with what you think is really sort of the groundbreaking new thing to do. And that's what we're trying to do here with XL.
Well, I'm not sure how into labels you are, but just to be clear, is this an active fund or a passive fund?
It's totally passive, but I think it's more active, or more, we call it dynamic, than your sort of grandmother's S&P type ETF. And I think when you think about what a S&P 500 or a market cap weighted index is doing, they're just buying a basket of stocks and weighting it from the largest company to the smallest. And so there's no real intelligence, if you will, in that strategy. It's just buying all stocks. What we're doing, obviously, is combining a lot of what people would associate as active sort of fundamental, stock picking evaluation metrics, but blending those into a fully rule-based methodology. And so it's completely rules-based, but it's definitely more dynamic than your kind of average index fund.
And then I guess a question I've always been curious about in general, and I'll ask you because you're an ETF manager, is what goes into deciding the expense ratio?
So, I mean, a number of things. Probably the most important thing and most obvious thing is the competitive landscape. And so what a lot of people do from time to time is, they're bringing out a strategy that's very similar to something else. And therefore, largely the price or the management fee, whatever you want to call it, is going to be kind of dictated by what the market is already paying for a similar strategy. I think, with us, what we sort of felt was if you take, the kind of S&P side of the market and you say, well, that's just a basket of stocks. There's no IP. There's no sort of intelligence in that strategy. And people are buying that for effectively zero these days. But what's at the other end? Well, the other end is, pure active management, ideally, or hedge funds maybe. Then people can pay north of, 1.5%, 2% for that sort of strategy. So what we think X out is somewhere in the middle. So it's much more dynamic than a traditional index, but it's completely rules based and it's much less expensive than a traditional active manager in the large cap space.
All right. Will Rind is the founder and CEO of GraniteShares. XOUT is the symbol of his new ETF. Will, thanks so much for the time.
Thank you. Great to be on. Thank you.
All right. 8:46 here, guys. What's happening out there? Anything interesting?
Quiet.
Quiet Friday?
Yeah, quiet wall here.
It is option expiration, though.
Yep, it is. It is.
So we do see a lot of sell imbalances here this morning. That is not moving the stocks yet, but they just got bigger just now. They just now got bigger. See those S&Ps? All you traders that believe the S&Ps lead all the time, you just got proven wrong right there, because all those sell imbalances just came on the stocks and they just sold the S&Ps off, 1.5 points on that right now. So we're seeing sell imbalances across the board. They are dictating it to a certain extent. That is why you are seeing some weakness here just in the last couple of minutes as these sell imbalances are growing. Again, this is option expiration. Those things can change really fast. But right now, I'm seeing I'll just give you a few examples. Bank of America, 458,000 to sell. Merck, 136,000 to sell. Pfizer, 241,000 to sell. AT&T, 268,000 to sell. Our friend General Electric is only 447,000 to sell. It's always got a sell imbalance. Berkshire Hathaway, 115,000 to sell. I mean, it's across the board. Sell imbalances right now. That's why the market is leaking.
And for all you people that are on the opposite side of the coin, when the S&Ps are up 30 handles in the middle of the night, when no stocks are open, those stocks are forced to open at prices because of the S&P futures.
One quick stock before we go to our next guest. We'll do Intuitive Surgical, ISRG. They had earnings after the close yesterday. They beat on their EPS by a lot. $3.43 EPS versus a $2.99 estimate. Sales also beat 1.12 versus $1.06 billion.
It's a nice lift. I own the bots in my long-term investment portfolio, BOT, a zebra there. It is loaded up with ISRG. If you look, actually, the charts are very similar because it's the biggest holding. So if you're trading BOTZ today, that is one that could be a catalyst for it moving. ISRG up $18. Joel, give us technicals.
Well, your pre-market high, they got a little bit excited. They took it to 554.40. But I'm going to stay within the realm of the regular sessions, and the all-time high is 549. So use that potential target. You could easily get lifted at 549. It could go 552 bid, and then you get up and get a drink of water, and it could be at 537. So it's one of those stocks. If you want to sell it on a day, you want to sell it when it's going up. This is a day approaching all-time high. Also, it got up to this area. Oh, I'm wrong. That's not the all-time high. All-time high is 581.12. I stand corrected. So I'll use that recent high of 549 as a target. If you're holding up for the all-time high, that's quite a ways away at 581.12.
All right, it is 8:49. I want to take a quick break and grab our final guest of the day and the week, William D. Cohan. He is an author. He's also a special correspondent for Vanity Fair. He wrote that great article yesterday that we talked about insider trading. So I'll give William a call. We'll be right back in a moment with William D. Cohan. All right, welcome back, everyone. Pre-market prep, Spencer Israel, Joel Elconin, Dennis Deck. As I mentioned, we are joined now by William D. Cohan, special correspondent for Vanity Fair, longtime Wall Street author. William, good morning.
Good morning. Thank you for having me.
Thanks for coming on. First of all, I just want to tell our audience here that Mr. Cohan has written at least 4 books on Wall Street. I love to read books about the markets. Do you have a favorite one, or the one that's most related to trading? I saw you wrote one about Goldman Sachs. So when I go on vacations, I read books. Which one of your books do you suggest I reading first?
That's like asking me which one of my children do I love more. Look, the book I wrote about Lazard, was about a banking firm. Book about Bear was about how it collapsed in the financial crisis, and the book about Goldman was about its history and how it survived the financial crisis. So there's elements of trading, certainly in the books about Bear and Goldman Sachs. Lazard didn't do a whole lot of trading.
Okay, so let's move on. Your article here about some suspicious trading activity in the E-mini S&P futures. So just kind of walk us through here, through the timeline of you becoming aware of this, where the information came from, and then how you started your process.
So obviously, like any good reporter, I have sources throughout Wall Street and the industry, and of course, I'm not going to reveal my sources. But one of the interesting things to me is I wrote a story about this also in Vanity Fair in early July. Same idea, same kind of trading pattern that basically got zero attention. Maybe everybody was at the beach. I wrote this, obviously yesterday as a follow-up, but, i.e. this is still going on, and traders are still seeing these kinds of unusual trading patterns and wondering how this is happening. And it seems that if people are taking profits, they're making a lot of money. Yesterday it exploded. So I don't know what changed between July and October. Maybe the impeachment proceedings. The media is more highly tuned to anything that might look sort of negative for Trump. But the idea here was, I was just being reportorial about what, like any good reporter, what I was hearing in the marketplace. And this was the sort of second story that I wrote about it.
So the central point of your article is that there are several suspiciously well-timed trades in the S&P E-minis. Can you outline sort of like what and when those trades have occurred?
Well, so again, I think one of the points of the article is that there was a feeling, not me, I'm not a trader, right? I'm just a reporter. There was a feeling among traders or people who trade E-minis who've been noticing these, very well-timed trades, and often that they were related to market-moving events. So, you don't have to be an idiot or a genius to see that that there's been a lot of roller coaster activity, a lot of up and downs, a lot of vicissitudes in the market related to the China trade negotiations. And frankly, I think most people, I would say 99.99% of people, have no idea what Trump is trying to accomplish with the trade talks with China. All we know is that sometimes they're on and going well, and sometimes they're off and going poorly, and sometimes he's putting tariffs on because they're not going well, and he's holding off on tariffs because they are going well. And again, I think if you look at his statements, and again, I haven't done this, but people who trade in these E-minis have done this. There's a correlation between his commentary and the way the market responds. So people are starting to trade that volatility, and so and sometimes they're successful at it, and sometimes they're not. And I think the point of this article was that not only there have been instances when Trump, who obviously is quite savvy and talks about the market all the time, is very focused on the market, and is also very focused on what the market is as a barometer of his success as president of the United States, that people that he moves the markets, and people are sort of either getting lucky and taking advantage of that, or as the suggestion that was made to me is that there are people close to Trump who are actually doing the trading or organizing the trading or making it possible for this information about what Trump's going to say about the Chinese the tariff negotiations or anything else that he wants to say that moves the market, and people are seeming to make a lot of money, assuming that they sell their positions out after they've made these huge profits.
Just going back to your comment that, and just kind of the process that led up to this, you said from the pits. So are you because there's only one physical pit left, and that's the S&P 500.
The pits. That's something I said to perhaps on CNBC. It's a metaphor.
Okay.
I'm a former banker. I'm sure this is all traded electronically, so there's no one physically in a pit. But this is from people who trade.
There are people physically in the pit. It doesn't trade a lot.
Well, there's physically people still on the floor of the New York Stock Exchange too, but I'm not exactly sure what they do other than serve as a background set for CNBC broadcasts.
Okay, because when I was looking at it, when you said, I thought it was because there's still a lot of people on the floor. It doesn't trade a lot of volume, but there's still S&P 500 pit. I didn't know if you were, if there were people, traders, clerks, whatever, observing, sitting there trading the big contract, observing the price action in the E-minis. I was just, because there was rumors. There do things that come out of the trading pits, and that's. I just had that question. Dennis had a question for you.
Well, I wanted to jump in here. You mentioned in the article, William, you reached out to the SEC. They declined to comment. CFTC, they ignored you. When you reached out to them, how did they appreciate your questions here and your line of questioning about this?
Well, I'm not sure what the word how they appreciate it. But I will tell you that the spokespeople at the commodities, the CME, the Chicago Mercantile Exchange, actually took what I was saying quite seriously, and they went away for 2 or 3 days, and then came back and said, well, as I said in the piece, we've talked to various people. We don't really see anything to this. I never said it happened in one trade. Obviously, it probably couldn't happen in one trade or one trader making these trades. But they said no. We don't see a single point of trading, and it doesn't really bother us. The SEC, I just got a quick no comment. But interestingly, then I got back maybe 2 or 3 weeks later an email from another person in the SEC. Press office saying, okay, I know my colleague said no comment, but what exactly are you talking about here? Which I thought was curious. And then, once the article was published yesterday, I sent that to them, and I have not heard back. And basically, the CFTC just ignored me. Didn't, I was told there would be no response.
Well, I'm Dennis Dick from Bright Trading. We've speculated on this show that it is possible that there could be some information leakage, not only from the Trump administration, but from potentially China as well on the other side of these negotiations. So I don't think it's out of the realm of possibilities that your argument could hold water. And I find it very interesting that there was some big trades ahead of this. So, I found your article to be very interesting for that reason. How do we know that, and how do we know that this couldn't be coming from the China side? These trades.
I think there's a very good argument to be made that China might be somehow along for the ride. Look, we're in the realm totally of speculation, right?
Yes,
but
for sure.
It wouldn't surprise me if Trump said, "Hey, look, my commentary about my tweets, my commentary about the tariff negotiations, moves the markets. You guys might want to get in on this too." I've made, I don't know that he would say this directly. The guy is capable of almost anything, right? But and it's not always necessarily nefarious. But I think that, I wouldn't be surprised if China and or other people who are party to these negotiations or these discussions are somehow making money on this too, sending in their trades.
Isn't there a way just to go in through the clearinghouses, through the exchanges, and find out exactly who bought those contracts and the timing and the people on the accounts? I mean, with the kind of surveillance and clearance we have now, I mean, wouldn't that be something fairly easy to do, to go in and see where the accounts, where they're, domiciled and who's doing it? I mean, to me, that would be, a simple way to find out who is doing this and investigate that. If it's offshore accounts or whatever, is that something that you think that the CFTC or SEC should do?
You're preaching to the converted on that. I mean, they leave a trail, right? I mean, they leave an electronic trail. They leave all sorts of records. Yes, so I don't think it's hard for the regulators, the SEC, the CFTC, even the CME, to find out who's made these trades and if there's anything to it. I mean, I was just reporting observations that people who trade these E-minis have been making to me over the last 4 or 5 months. And people who've been doing this a very long time and just noticing these, strange trades that seem to be extremely well timed, and that at least on paper, people have made a tremendous amount of money. But it would not take very much. I mean, look, if there were a merger that was had been announced, and there was unusual trading activity, volume activity leading before the merger, then the SEC seems to routinely investigate that and prosecute people for doing that. Obviously, insider trading rules and laws, don't apply the same way to these kind of future markets and the bond markets as they do to the equity markets, but the use of inside information, or potentially use of inside information to make huge profits, is the same concept. So, they should be looking at this exactly as they would if it were a merger that was announced and there was unusual trading activity in front of the merger. This should not be hard for the regulators if they are doing their job and if they are not totally in the pocket of Donald Trump.
All right, William D. Cohan is a special correspondent for Vanity Fair, is also a longtime Wall Street author. William, thank you so much for the time today.
Thank you for having me, guys.
All right, 9:03. That'll be it for our show for today and for the week. I want to remind you about the Webull WeTrader competition. Go to Webull.com or download the Webull app to learn more how you can win $11,000 worth of Amazon gift cards every week, or if you are the very best paper trader, you can win a Tesla Model 3 or $40,000 towards your student loan payments. Also, the Benzinga Cannabis Capital Conference next week in Chicago. BenzingaCannabisConference.com/Chicago. Promo code BZFAN, that's BZFAN, to get a discounted ticket. Thanks to both our guests today, William D. Cohan and Will Rind. Dennis, Joel, any final thoughts?
Before you go, Spencer, the sell imbalances have grown significantly here.
I see that.
I don't know if they're going to change, but they are significant. That is why we're down now 4 or 5 handles from where we were 20 minutes ago, because these things have gotten huge. Bank of America's 1.7 million to sell now. G is 1.8 million to sell. Pfizer's 1.1 million to sell. We were talking in the 100,000s. Now you can see we're talking in the millions. 1.4 million to sell in AT&T. And then there's just a pile. G's like 1.8 million. I mean, I'm just looking across the board. Philip Morris, 361,000 to sell. It's hundreds of thousands everywhere. So right now, significant sell imbalances. It's going to take some big institutions to offset these, or we're going to open lower.
Yeah, no, good call on that. As soon as you did mention that immediately, we did get a sell-off. We are now in the red, adding significance to that pre-market high at 3001.25. I mean, on the downside, we've had a quiet range really the last 2 sessions. So it's going to be kind of hard. It's going to be choppy. I don't think we get any major downside today until we take out 29.85. And I don't think we get any major upside here until you take out yesterday's high at 3,008. So it's not warm enough to maybe go golfing, but it could be just a quiet day here in the markets. We'll see what shakes out.
All right, everyone, have a great rest of your day. Have a great weekend as well. We'll be back with you on